Hi everyone, and welcome to ACCA P4 Live Session 3. The objective for the day should have been cost of capital continued and theories of gearing. But because we haven't finished the capital rationing, I will quickly want to go through the capital rationing and I will bring you back to the day's objective. So the day's objective would have been to look at the cost of capital continued and theories of gearing. So let's go back to where we stopped last session. Let's go back and we pick it from where we stopped last session. So last session we were doing capital rationing and we picked a question called Barney Limited, and we said because we are in a situation where we have a multi-period capital rationing, we would have to use linear programming if the projects are divisible. And doing the linear programming, there will be the need for us to think of the objective we would have to be achieving. And we said linear programming objective can either be actually maximizing the MPV or actually maximizing the present value of the cash flows available to pay dividend. And we were able to use the question to do the linear programming to maximize the MPV. So now we're going quickly to go and look at the linear programming to maximize the cash flows available to pay dividend, the present value of it. Okay, so I'm quickly reading through the question for us to refresh our minds. The management team of Barney Limited has identified the following independent investment projects, all of which are divisible. No project can be delayed or performed on more than one occasion. The projected cash flows during the life of each project are as follows. Year 0 up to year 4, project A up to F. The capital available at year 0 is only 50,000 and only 12,500 is available at year 1, together with any cash inflows from the project undertaken at year 0. From year 2 onwards, there is no restriction on the access to capital. The appropriate cost of capital is 10%. Now let's do the linear programming in relation to dividend approach. Okay, we all went through the stages last time and we said to do linear programming, you would have to define the unknowns, we would have to define the objective function, we would have to define the constraints, and we would have to define the non-negatives. So last week, we actually defined the proportion of project A, B up to F to be undertaken to be represented by their small letters. We're going to follow the same stages. The only thing that we're going to change here is now the objective is not to maximize MPV, but the objective is to make cash flows available to pay dividend. Because as we learned in F9, according to the dividend valuation model, your company share price should be equal to the D0, 1 plus the growth rate divided by the cost of equity minus the growth rate. So the more cash flows I will be able to make it available to pay dividend here, the more the market value of the share is going to be. And if the objective is to maximize the shareholders' wealth, then obviously the moment we increase the share price, we have increased the shareholders' wealth. So we want to ensure that if we have got 50,000 and then 12.5 in year 0 and then year 1, whatever cash flows that we will need to finance these projects in year 1 and year 0, whatever monies that we have to spend on those projects, plus monies we have to make it available to pay dividend. If we are able to make more money available to pay dividend out of the resources that we have, then we will be able to maximize the shareholders' wealth. So this is what we are going to do. So please flow with me and let's go straight to the PV of dividend formulation. So just as we did, you would have to come out with your unknowns. So these are the unknowns, which we've done it last week. Unknowns, so A, B, C, D, E, F. Small letters represent proportion of each of them. The second is to define your objective function. is to define the objective function. And here we said we want to maximize the present values of the cash flows available to pay dividend. And we all know that present value is the cash flow multiplied by the discount factor. Question told us the cost of capital of the company is 10%. So when we get the cash flows that will be used to pay dividend, we will discount those cash flows by the 10% discount factor. So our objective function, which is the Z, is to maximize the to maximize the cash flows available to pay the dividend. Do we know the cash flows available to pay dividend? That one too we don't know. So this is the only additional thing you need to remember here, because the argument is whatever monies that we have available, we would have to spend some on the project, and we also have to make some available to pay dividend. We don't know how much will be available to pay dividend, as we don't know how much of the proportions we have to do for each of the project. So you will be expected to redefine another unknown. The other unknown is the amount of cash flows which you need to make it available to pay dividend. So this is also an unknown. We don't know that one. Okay, so we are saying that if the projects are for a period of 4 years, then whatever monies I will have from year 0 up to year 4, I should be able to use some for the project, and I have to also make some available to pay dividend. How much cash I will use to pay dividend, I don't know. So we are indicating that let D0, D1, D2, D3, D4, because the project is for 4 years, D0 up to D4 represent the cash flows that will be available to pay dividend from year 0 up to year 4. Okay, so if I'll be able to represent these as the dividend that I will have over the 4-year period, how will I get the present value of the cash flows for dividend? And as I said, present value is that cash flow multiplied by a discount factor. Question told us that the cost of capital is 10%. Okay, here we are teaching, so I wouldn't recommend that you waste time to do this, because you can pick it from the table directly. Okay, so I need the objective function is to maximize the cash flows available to pay the dividend, present value of it. And I have defined D0 to be the cash flow to pay dividend in year 0. Discount factor 10% year 0 is 1. 1 times the cash flow to pay dividend in year 0 should be the same thing. Discount factor 10% year 1 is equals 0.909, and I would have to multiply by the cash flow that will be available to pay dividend in year 1, which we define as D1. Then year 2 discount factor multiplied by cash flow to pay dividend in year 2. Same for year 3 and same for year 4. So what we are trying to imply here is if we are able to use the monies available, pay some for the project, leave some for the D1, D2 up to D4, the more cash flows that will be available to pay dividend, the more we will be able to achieve this objective of maximizing the present value of the cash flows to pay dividend. And of course, we increase the share price and we maximize the shareholders' wealth. So this is your objective. So the only difference here is you would have to remember to define the unknowns in order to know how much you are making it available to pay dividend. Then next stage is come out with your constraints. What will be the constraints? Be with me here again. We said we needed the cash flows to pay dividend from year 0 to year 4. Okay, even though the question gave us only 2 constraints, which is year 0 and year 1, 50,000 and 12,500, because we needed the cash flow available to pay dividend up to year 4, we would have to do the constraint up to the end of the number of years of the project. Project here, 4 years. So how should I do it? If I start with year 0, just as we did with the MPV approach, I would need 25 on A, so 25A plus 25B plus 12.5C, D was 0, so you can leave it out, plus 50E, these are the cash flow outflows in year 0, 20F, and then be with me. The argument is we had 50,000 available. Whatever monies I will spend on project A, project B, project C, D, we didn't need any money. E, and then F, plus whatever monies I can make it available to pay dividend in year 0 should not be more than the 50,000 I have. So it should be less or equal to that 50,000. That is why you see it here like this. So the additional thing you are bringing in addition to whatever we did and the NPV approaches, because we want to know the amount we have to use to pay dividend, we would have to bring the D1 because we don't want to spend more than what we have. So whatever I will spend on the project plus whatever I will make available to pay dividend should be equals or less than whatever monies I have. If you go to year 1, we have 50 to spend on A, 25 on B. C was positive, so as we did last week, it should move to the other side. All the inflows goes to the other side. Then D was outflow, E was an inflow, and then F was outflow. And monies available was 12.5. But I also have to make some of the monies available to pay dividend in year 1, and that is what we are referring as D1. So whatever monies I will spend on the project, whatever monies I can make available, I should make sure some is also available to pay dividend in year 1. Then we do the same thing for year 2. Even though year 2 they didn't give us any constraint, what will be the monies available? A is bringing in money. It should go to the other side of the equation. B is a cash inflow. C is a cash inflow. D is an outflow. E is an outflow. F is also an inflow. Therefore, all these monies I can make on the project, and I spend some on D and F. I also have to make some available to pay the dividend in year 2, which is the D2. If you come to year 3, for instance, all the project brought cash inflows. So that is why you see all of them here. What is it telling you? As long as I don't need any of the money to finance any of the project, whatever monies the project will bring, those monies should be available to pay dividend in year 3. The same applies to year 4. So the bit you need to remember to bring should be this bit. Okay, otherwise it's the same as whatever you did before. And you also have to remember you have to do it over the life of the project, because you need the dividend cash flows for each of the life of the project. Then you also come out with your non-negatives, and the non-negatives will be of the fact that your A up to F, they should be less, they should be more or equal to 0, or they should be less or equals to 1. They have to fall in between. You can't do a negative of a project. You can't do more than 100% of a project. And you also have to remember, you can't pay a negative dividend. You cannot pay a negative dividend. So the dividend that you pay in each year either is equals to 0 or is more than 0. So that is what you also have to bring in. And you tell the examiner when this is solved, then we will be able to get the A, B, C, D up to F, and then the D1, and then the D2 up to D4, and then we will be able to get the maximized amount. So if we are able to solve this equation, we will be able to get the D0, D1, D2, D3, D4. And then when we find the present values of those cash flows available to pay dividend, straightforward, it gives you the maximized amount, and you maximize the shareholders' wealth. To be honest, this is not popular. The most one is the NPV, and even that one has been in the P4 exams only once. Most of the time, it is a single period capital ration that comes. Okay, so now let's go to dual values. Let's go to dual values. What do we mean by dual values? Dual values has got alternative names. Let me bring them up. So examiner can say either dual value. Can you bear with me in a minute? Let me get my pen right. Dual value, or he can say shadow price, or he can say opportunity cost. In all of them, the examiner can hide the question by asking you to calculate the maximum premium. The maximum premium. The examiner can hide and ask you to calculate the maximum premium. I'm going to explain. Dual value or shadow price or opportunity cost or the maximum premium. This is how it goes. We says we are having a capital restriction. That is why we would have to do capital rationing. Therefore, as a result of lack of capital, I am not in position to actually undertake all the project I want to undertake. So if I'm not able to undertake all the project, then the MPVs of the project I couldn't undertake are forfeited because of the fact that I am not able to bring money. So lack of that money, I am foregoing some benefit. That benefit I am foregoing is what is called the dual value or opportunity cost or shadow price. Opportunity cost of not being able to undertake that particular project to enjoy the MPV, all because of lack of money. Therefore, the question is going to ask you, if I should bring in extra money, if I should bring in that extra money, what will be the benefit I will get? If I should bring in the extra money, that extra money will enable me to undertake the project I couldn't originally undertake. So the benefit I will get for bringing in the extra money is simply in relation to the MPV of the project that I couldn't undertake. Normally, this is what I tell students about. Okay, let's assume I have got £300 available. I've got project A, B, C. They are initial investment. This is 100, this is 120, this is, let's say, 140. There are MPVs here. This is 20, this is, let's say, 40, this is 60. What then will be their profitability index? I'm simply assuming these projects are divisible. So this is 0.2. 40 divided by 120 will give me 0.33. 140, 60 divided by 140 will give me 0.43. So I'll say, give the money to this one first. Second, give the money to C first. Second, and then third, like this. So if I'm preparing my investment plan, I will say I have to start with C. C will need 140, enjoy its MPV of 60, followed by B. B will need 120 and enjoy its MPV of 40. The rest should go to A. The total I have is 300, so 140 plus 120. From the 300, it will be left with 40. This is what we normally do. So because A is divisible, I am doing 40 out of the 100. A will require, okay? And as such, I will enjoy 40% of its worth, the 20. So 40 divided by 100 times 20 is giving me 8. So total MPV I will get here will be 108. What we are saying here is that because I needed 360 here, because I needed 360, that would have enabled me to do all the project, and I haven't got it because I've got only 300. Instead of me doing all the project to enjoy MPV of 120, I am not able to do it because I'm lacking money. Therefore, I was able to make MPV of only 108. In that case, I am forfeiting, I am foregoing 12. I am foregoing 12 as a result of lack of money. Therefore, my shadow price, my opportunity cost is telling me that how much value, how much extra value the company will get, extra value to gain by bringing 1 unit of the limited resources. In other words, we can also see that shadow price as the value lost due to diverting 1 unit of the limited resources. This is the meaning of shadow price. Okay, so I'm going to use this to illustrate. If I don't bring in that extra money, I wouldn't be able to do all the project to enjoy the 120 MPV because I am constrained with only 300 pounds. Therefore, I am sacrificing this. If the examiner is going to trick you, instead of him telling you to calculate the shadow price, because we said 1 unit by bringing in 1 unit, the examiner is going to trick you and ask you here that, okay, if you have to bring in extra money, how much maximum premium you should be prepared to pay? How much maximum premium you should be prepared to pay? If I have to bring in £1 in addition, it means now my capital will be 301. If it is 301, what will be my investment plan? I have to bring 301 here. It means I can do 41. If I can do 41, then the proportion here will be 41 divided by 100 multiplied by 20. So 41 by 100 times 20 is giving you 8.2 as MPV. And aside, this one will be 108.2. So shadow price is telling you when I should bring in that extra £1, I will be able to increase my overall MPV by 0.2. And therefore, the maximum premium I can pay in order to bring that £1 is to give out all the benefit that £1 will give to me. And that benefit that £1 will give to me is that 0.2. So that is the way examiner will trick you. Because normally when they say shadow price, dual values, we are okay with it. So normally he calculate the premium. The premium should be the benefit. The maximum premium you should pay to bring the money is to give out the whole benefit. So if the £1 will give me 0.2, obviously I have to give out what? The 0.2 maximum, so that at worst I will break even. So that is the argument. The next argument and shadow price is also the value you will lose as a result of diverting 1 unit of the limited resources. So let's come here again. For the sake of argument, I am going to create this scenario that, okay, currently we have only 300. If we have only 300, then there will be the need for us to do a new project called Project D. Project D will need £40. And Project D will bring MPV of 10. Okay? Should we undertake Project D? If we are capitally rationed, it means we cannot raise money from anywhere. The maximum we have is 300. So for me to do Project D, I would have to take the money from what? The 300. If I take the 40 D will need out of the 300, I will be left with what? 260. So if I have to be left with 260, then it means I wouldn't be in position to do Project A. If I am not able to do Project A, then I am forfeiting the benefit I could have got as a result of doing Project A. That is why it's called opportunity cost. So by diverting the £40 to go and do Project D, I am going to forfeit £8. And when I forfeit £8 and I do the project on D, I will bring NPV of £10. Therefore, by diverting the money from the current activity to a new activity, I'm going to introduce £10 by sacrificing £8. So the examiner might ask you, calculate the shadow price of it. It's simply what? The 8. That is what you are losing. But whether I have to undertake Project D or not would depend on what is the opportunity cost of me diverting the money. The opportunity cost, which is the dual value of me diverting the money, is 8. Because when I divert the 40, I am going to lose 8. And I will bring in 10. Therefore, if I bring the D, I will increase my shareholders' worth by 2. So this is basically the dual value. I just did this because normally it comes as single period. And what I can conclude here is this. when it's a single period and the projects are divisible. Don't bother yourself to do all these calculations I've done. When they tell you to calculate the shadow price is simply the profitability index of the project you rejected. This argument that I did earlier, we saw that we increased it by 0.2 by bringing in 1 unit. Every unit of the limited resources I can bring, because A was not fully done, B was fully done, C was fully done. Any extra money I will bring, I would have to use it to do A. Profitability index of A is 0.2. So when they tell me to calculate the shadow price, straightforward. I look at the project, I didn't do it, and I calculate its profitability index. That profitability index is what I'll bring if I have to bring in £1, because that profitability index is giving you the profit per the pound brought. So any £1 I will bring, that £1 will go to A. If I do £1 of A, what is it going to give me? It's giving me that profitability index. That's it. If I have to divert, diverting means I'm diverting 40. For every £1, I have to what? Get profitability index of 0.2. 0.2 of the 40 is what is giving me the 8 here. So just pick it from there. It's just the profitability index. Now let's go to our note and we see a situation where it is a linear programming. That is a multi-period capital rationing. So Brunel Limited is experiencing capital rationing during both year 0 and year 1 in relation to the number of divisible projects. It has used linear programming to develop an investment strategy over a 3-year planning horizon for dividend payment using a cost of capital of 10%. Shadow prices have been calculated under the MPV formulation for the 2 years of capital constraint and under the PV of dividend formulation for the 3-year planning horizon. The dual prices per £1 of the capital available are as follows. NPV method, PV of dividend method, year 0 up to year 4. A new investment opportunity has emerged with the following cash flows, year 0, 1, and 2. Appraise the new project using both the NPV dual prices and the PV of dividend shadow price. Let me clear something here. When we did the linear program, we said we are not expected to calculate or solve the equations because it is computerized and that we can't do it manually. So if the examiner wants to do shadow price and linear programming, he has to give you the figures. So he's telling you, if you had used the MPV approach, these are the shadow prices per pound. What is the meaning? The meaning is any extra £1 you will bring in year 0, you are going to get a benefit of 0.1. Any £1 you will divert in year 0, you are going to lose 0.1. Any £1 you will bring in year 1, you're going to get 0.08. Any £1 you will divert, you're going to lose 0.08 in year 1. In terms of year 2, when you bring in £1 or you divert £1, you are not going to lose anything. You are not going to gain anything because at that point there wasn't any capital rationing. Okay, the same way, if you have to use the PV of dividend approach, your shadow prices are these. Okay, and it's telling you any £1, this is what you get or lose. This is what you get or lose. This is what you get or lose. Okay, now a new project had come in. If we are capitally constrained, then this new project can be financed only through the existing capital we have. Therefore, if this new project will come in, is this new project in the first place worth undertaking? So you need to calculate the MPV of the project. And this project is giving you these cash flows. Cost of capital is 10%. Everybody knows how to calculate the cost of capital. So we have got the cost of capital here. We will multiply by the cash flows. We will get the MPV. Therefore, this new project is worth undertaking because it is giving us a positive MPV of 11.75. However, we haven't got money to do this project. So there will be the need for us to raise the money from existing capital. And the moment we are going to pick the money from the existing capital, what's going to happen? We have to forfeit some activity. And by forfeiting some activity, there is an opportunity cost, which is the shadow price. Okay, so what we're going to do here is that what will be the overall shadow price of bringing this project? Question told us that for every £1 I will divert or I will bring in year 0, this is the shadow price of it, either the benefit or the loss. Therefore, if I have to do this project and I need 75, this 75 minus will be diversion, and therefore I will lose 0.1 times the 75. Okay, so that is what we did here for you. So when you come here, the total shadow price or opportunity cost will be, these are the cash flows of the project. Every £1 in year 0, I will lose or I will gain 0.1. So if I'm diverting 75, I am losing 0.1. And as such, I will lose a total of 7.5. But year 1, what happened? I brought in 50. That 50 is a cash inflow. So if I multiply by that shadow price, it's an extra benefit to me. And that is the 4. Year 2, nothing happens. And therefore, over the project, if I have to bring the new project, my overall opportunity cost is going to be 35 or 3.5. And we said, when we're doing the relevant cash flows, we said to undertake a project, when you are taking that decision, you would have to consider opportunity cost. So as a result of doing this new project and diverting money or bringing in money, I will lose a total value of 3.5. Therefore, when I do this project, I am not going to enjoy the whole of its MPV of 11.75, but I will enjoy the 11.75 and lose the 3.5 because I'm capitally constrained. And therefore, I should be able to increase my shareholders' wealth by 8.25, telling me that straightforward the project is financially acceptable. So I'll be happy to divert the money because I will lose the 3.5 and I will bring in 11.75. My shareholders' wealth will increase. Now, let's go to, this is the MPV approach. If we did the linear programming on the basis of the dividend approach, how will we calculate the shadow price? Is the same argument. The cash flows from the project multiplied by its shadow prices. And now be with me. This gives you the net figure directly. This gives you the net figure. Whichever you use, you have to come back to the same answer. This gives the net figure directly. This is the reason. The reason is, you look at the question, even though you are not supposed to be calculating those. Examiner has to give you this and that. Okay, but to make explanation easy here for us, we try to show you how this was calculated. If you look at the cost of capital 10%, discount factor 10% year 1, year 0 is 1, year 1 is 0.909. So these are the discount factor at 10%. And these figures here are the shadow prices of the MPV. So we have added the two in order to give you that of the PV of the dividend. This is teaching. In the room, don't bother. Okay, the examiner has to give it to you. Therefore, I have factored the discount factor I used here. At the same time, I have also factored the shadow prices I used here. When I bring the two together, when you bring the two together, that is what gives you the 8.25 directly. So what the note is telling you here is that the moment they give you the shadow prices for the PV of dividend approach, and then you multiply them by the cash flows of the new project, you are not going to deduct anything from it. It is already included in the calculation of the shadow price. So the answer that you get should be the net effect. The answer that you get should be the net effect. So that is basically the case for the shadow price. Now let's go to multi-period capital ration, where we have to use the integer programming. Last week we said that As long as we're doing capital ration, we need to ask, is it single period, is it multi-period, is it divisible project or non-divisible? If we are in multi-period and the projects are divisible, we have to use the linear programming, either the PV of dividend approach or net present value approach. If the projects are non-divisible, then we would have to use the integer programming. So that is what we are going to illustrate. We have to use the integer programming. As I keep telling you, examiner will not give you the headings. You would have to lead yourself. So I read the question. The management team of Toby Limited has identified 4 indivisible projects which require funds to be invested over the next few years as set out below. Project A to D, year 0, 1, and 2. The board of directors of that company has approved the following capital expenditure programs for those same accounting period, year 0 to 2. The 4 projects are expected to produce the following positive net present values. Project A up to Project D, Project MPV. As long as all of them are having MPV, we would have been happy to do it. But have we got enough money? We have been restricted for 3 years. Okay, and these are the costs that we have to incur. Okay, so how should we do this? The projects are indivisible. Capital is lacking more than 1 year. So we have found ourselves in a multi-period capital ration with indivisible project. So we have to do the allocation on the basis of integer programming. Integer programming follows the same principle as linear programming. You have to define the unknowns. You have to define the objective function. You have to define the constraints. And you have to define the non-negatives. The same thing. The only problem is the definition of the unknowns. Okay, the only problem is the definition of the unknowns. The unknowns, as we did with the divisible project, we said let small a represent the proportion of project A, because at that point the projects were divisible. Now these projects are not divisible. So once they are not, you either have to do 100% or you have to do 0. So when you are defining your unknowns, you're just going to say so this will be my unknowns. You're going to say, let A represent either 100% or 0% of project A to be undertaken. Do the same thing for B. 100% or 0% of the project to be undertaken. You can't do in between. Either you are doing it as a whole or you're not doing it at all. So that is the only difference. The next one will be your objective function. The next one will be your objective function. What will be your objective function? So far as integer programming is concerned, you're supposed to do to maximize only MPV. So I want to maximize MPV. So I will say if I need to maximize MPV, my Z will be MPV of A plus MPV of B plus MPV of C plus MPV of D. Okay, so 2027, 500, 15, and 10. So I'm going to have 20,000 A plus 27,500 B plus 15,000 C plus 10,000 D. Okay, this is the argument. You cannot say you want to do a proportion of these because the projects are non-divisible. So it's possible A will be 0 or A will be 100. Whatever percentages that you will get given your capital constraint, you put them in there. So it's possible that A and B might be 100% and C and D will be 0. So whichever figures that you get for the C, D, A and B, when the equations are solved, then it will be able to give you your Z function. And what will be your constraint? The same thing, the same as we in the linear programming. So your constraint will be this. Now be with me. Okay, your constraint will be 17,500 A plus 22,500 B plus 0C plus 12.5 D. All of them should be less or equal to the 40,000 you have available in year 0. Same way, if you come to year 1, 25,000A, 0B, 15,000C, 15,000D should be equals or less than the 35,000. And then here 10,000, 30,000 B, 20,000 C, 17,000 D should be less or equal to the 42,500. That is what we did here for you. So you can see that. Okay, so it's the same as we did last week. It's the same as we did last week. Okay, that's the case. Okay, but when you look at this, they try to solve it for you. And the conclusion was that you do 100% of A, 100% of B, nothing of C, and nothing of D. You are not expected to solve it. ACCA is not expecting you to solve it. So all what you're going to tell the examiner by forming this equation. And you also have to come out with your non-negative that A, B, C, and D should either be equals to 100% or 0%. That's it. Okay, and when the equations are solved, you should be able to come out with the A, B, C, D percentages, either 100 or 0%. That will maximize the shareholders' wealth. So if you know linear programming, you know integer programming. The only difference is how to define the unknowns. Linear programming, because the projects are divisible, you will actually say proportion of A, B, C, D. But if it is integer programming, you're going to say either whole or zero. That's it. Okay, so let's say bye-bye to the capital rationing. Risk and uncertainty. We all know that the investment that we're doing does not relate to today. The investment relates to the future. And who knows the future? Nobody knows the future. Why? Because there are so many possible outcomes. Is it possible for us to use the past as a basis of predicting what the future outcome is likely to be? If it is possible to use the past as the basis of predicting the future, we say we are doing risk analysis. If it's not possible for you to use the past information to predict what is going to happen in the future, we say we are doing uncertainty. So risk can be measured using past information. Uncertainty cannot be measured using past information. And how do we incorporate risk and investment appraisals? How do we? Yes, the integer programming is only for indivisible. Linear programming is for only divisible project. Okay, so that is the case there. Let's come back. The methods that we can use to incorporate risk and investment appraisals include sensitivity analysis, probability estimates, and cash flow, certainty equivalent, adjusting the discount factor, simulation method. Okay, what we're going to do will be the sensitivity analysis. Adjusting the discount factor, we will see it in cost of capital, and simulation, we just have to talk about discursive bit. What is sensitivity analysis? What is sensitivity analysis? We all said to calculate MPV, you need three variables. You need the number of years, you need the relevant cash flows, you need the appropriate discount factor. The moment any of these variables will change, the MPV obviously will change. For instance, when we were calculating the internal rate of return, we made mention of the fact that if I've used 10% cost of capital and the MPV is positive, if I want a negative, when I increase the cost of capital, the MPV will be negative. Okay, so that is telling you that MPV depends on the discount factor, the relevant cash flows, and the number of years. The moment any of them change, the MPV will also change. But nobody knows the future with certainty. So when we were calculating the MPV, we estimated all the variables. We estimated cost of capital. We estimated the number of years. We estimated the relevant cash flows. Okay, so to incorporate risk, the question we're going to ask ourselves is, this estimate that we've done, we are not 100% sure of them. So therefore, what will be the worst case scenario? The worst case scenario is for the MPV to be equal to 0. So if the MPV should be equal to 0, so that at least we break even. So we're going to ask ourselves, how much should any of those variables used to calculate the MPV change? in order for the NPV to be equal to 0. And that is what is a sensitivity analysis, because it's telling you the NPV is sensitive to those variables, because the moment any of those variables change, the NPV will also change. We don't want to make a loss. The worst case scenario is for the NPV to be equal to 0. So how much should those variables change for the NPV to be equal to 0? And that is what is called the sensitivity analysis. In other words, as long as you are doing project appraisals, or let me put it this way, investment appraisals, the examiner might hide the sensitivity analysis in the name of break-even analysis. We all said when the NPV is equal to 0, the project has break-even. Therefore, examiner can tell you, calculate the number of years for the project to break even. Indirectly, calculate the number of years for the NPV to be equal to what? 0. And that is sensitivity analysis. Calculate the cost of capital. That will let the project break even. Calculate the selling price. That will let the project break even. All of them are sensitivity analysis. So what I tell my student here is, any question that you're doing and it's investment appraisals, and you see calculate something that will let the NPV be 0 or for the project to break even, the examiner is simply testing you and sensitivity analysis. And that is the sensitivities in here. So they've given you the formulas. If you are doing any cash flow item like selling price, unit, variable cost, fixed cost, all of them, because they relate to cash flow items, you need your margin of error. And that percentage margin of error is calculated as the NPV divided by the present value of the cash flow item under consideration. So for instance, if I want to know how much should the selling price change for the NPV to be equal to 0, I would divide the NPV by the present value of the sales. Present value of sales. If variable cost, NPV divided by present value of variable cost. If it is unit, I will have NPV divided by the present value of contribution. Because when my unit decrease, my sales will decrease, but that unit will not be produced. Therefore, I will lose the sales and I will save the variable cost. So what I actually lose is the contribution. Okay, so for unit is the NPV divided by the present value of contribution. What is the sensitivity for discount factor? Okay, what is the sensitivity for discount factor? Okay, sensitivity for discount factor is the discount factor that should break even the project or make the NPV equals to 0. And we all said that the NPV is equal to 0 when the discount factor is equal to the internal rate of return. So for the examiner, sometimes instead of saying internal rate of return or calculate internal rate of return, he's going to tell you calculate the cost of capital that will let the project break even. It's the same as internal rate of return. Calculate the number of years that will let the project break even. Is the same as discounted payback period, which we know how to calculate all of them. So we are not showing you how to calculate discounted payback again, how to calculate the internal rate of return. We know that already. So it's only the cash flow bit that we are doing next. So they said an expected NPV has already been calculated for the following project, okay, of CCPLC. Yeah, 0, 1, 2, 3, 3. Cash flows, discount factor, NPV is positive. Everybody is fine with the basic calculation of this NPV. As long as the NPV is positive, this project should go ahead. Are we 100% sure of these variables we have used here? We cannot be 100% sure because all of them are based on estimate. How much should any of these figures change for the NPV to be equal to 0? Okay, that is the sensitivity. If you need any of the cash flows item here, we said is the NPV divided by the present value. So when I pick initial investment, it's going to be the NPV divided by the present value of the initial investment. And as such, we had what? 7%. Meaning is, as long as your cost or initial investment increased by 7%, your MPV will be equal to 0. Technically, if you look at it well, this should have been 6.99%. They approximated it. If I increase 100 by 6.99, it will give me 106.99. It will wipe up this 6.99 here, and MPV will be equal to 0. Annual sales revenue. Pick your MPV, divide by PV of the revenue. If you want scrap value, MPV, divide by PV of it. Sales should decrease because we are bringing the MPV. Any cash inflow item, it should decrease by that percentage. And any cash outflow should increase by that percentage. Okay? How to do year 1 to year 3, you need annuity factor. Because you said every year is 40. So if it's 40, 10%, go to the annuity factor table. Go to the annuity factor table. If you go to the annuity factor table, 10% 3 years will give you 2.487. Okay? So go to the annuity factor table, not the present value table. Okay. Right. So this is basically that. How to calculate the internal rate of return. Everybody knows how to do that. So this should be the discount factor that will bring the MPV to be equals to 0. Now let's see Monte Carlo simulation. Monte Carlo simulation. Monte Carlo simulation was developed because of a criticism based on the sensitivity analysis. Sensitivity analysis, even though it's a brilliant analysis telling us the boundaries, what is the maximums and what is the minimums, that will bring the MPV to be equal to 0. When I am varying selling price, for instance, if I want to know how much selling price will change, I change only the selling price as the variable. All other variables like number of years, cost of capital, all other variables, we are going to hold them constant. So the major problem of sensitivity analysis is that it varies one variable in isolation of other variables. So when I am varying sales, I hold all other variables constant. Fixed cost will stay constant, variable cost, number of years. But in reality, at the same time that my selling price is changing, at the same time, my variable cost, the number of years might change. So sensitivity analysis is not able to cater for changes of more than one variable at a time. So we needed a model that will be able to look at changes in many variables at a time. And that is the reason why the simulation method was developed. So simulation method is basically a mathematical model. Okay? Just discussion that you need here, no calculations for you. Is a mathematical model which is going to combine all the possible future outcomes and the probabilities of them occurring. And it follows these stages. The first one that you need to know is you have to specify all the major variables associated with the project. And when you specify all those variables, also look at the relationship between those variables. Okay? And then you come out with the probabilities of them occurring. And you prepare a big probability distribution table. Those who did statistics will be very happy with me. Those who haven't done it, don't bother. You can just learn the stages because that is all what you need. Okay, so specify the major variables, come out with the relationship between those variables, come out with the probabilities of them occurring, and develop a probability distribution table, and then you simulate. The good aspect of simulation, as we said, will look at all the variables and their relationship and their likelihood, that is the probability, their likelihood of them occurring. However, it has got major problems. The major problems are in here. Again, the major problems are basically the stages. How will you be able to specify all the variables associated with the project? Difficult. How will you be able to know the relationship between all of them? Difficult. How will you be able to assign probabilities to each of the future outcomes? Oh, it might be 10% likelihood that the economy will be recessed. It will be 100% or let's say 40% likelihood economy will be expanding. They are not easy things to come by. Okay, so this is basically your simulation. Project value at risk. Here we have to do some calculation. The last time that was tested was the December exam. Be with me. Project value at risk. Okay. What is project value at risk? What I can say here is they brought project here because we're doing project appraisals. You don't need value at risk only when you're doing this investment appraisals. Anytime you have any value, anytime you have any value, and they ask you to calculate the value which is at risk. It could be a project, it could be hedging, it could be anything. As long as you have got a value, how much of that value is at risk is what is called value at risk. But because we're doing investment appraisals, our MPV is our expectation. So if I've calculated MPV and I have got 200, because it's positive, I will say I have to go ahead. However, am I 100% sure of the 200? Am I not? Therefore, how much of that MPV, given the risk associated with the project, which is measured as standard deviation, is not your job. The examiner has to give you the standard deviation. Your expectation is calculated using expected value, which is mean. And deviation from the mean is what the statisticians will say is called standard deviation. No, there's no calculation on Monte Carlo simulation, okay? There's no calculation, just discussion in here. We're not doing any calculation on that, okay? So my MPV is what is calculated as the expected value. That is what you expect to get. That expected value, you are not 100% sure. What is the risk associated with it? The risk associated with it is measured as a deviation from the expectation because your actuals might deviate from the expectation, and that is what the statisticians measure it as standard deviation. So your value at risk is how much of the value you have you believe you are going to lose it. The monetary amount, you believe you are going to lose it. Given the risk associated with the project measured as standard deviation and your confidence level. So I normally make it very simple for students because value at risk, you have to understand what is called the normal distribution function. And normal distribution function is not technically in the syllabus. It's pure statistics. We are adopting that principle. So the examiner will expect you to go straight. So questions on value at risk are very, very straightforward. Apart from last sitting that the examiner was a bit funny, which I don't really know why he did that. So I'm going to take a step further to explain how you get those values. Okay. So value at risk is simply the value you are likely to lose given a standard deviation which is measuring the risk associated with the project and obviously your confidence level. So when they tell you to calculate value at risk, this is the formula we would have needed. But I know this is too much into normal distribution. So I've changed it and I've made it very simple. Okay, so when somebody asks you to calculate value at risk, just simply calculate it as the standard deviation multiplied by your tail value. Sometimes people call the tail value your Z value. Sometimes some people call it your Z value. Your tail value or your Z value depends on the confidence level given to you. And the examiner is supposed to give you the confidence level. It was meant to be either 99% or 95%. But for whatever reason, I don't know, last sitting the examiner did 90%. So I'm going to show you how to get the percentage, how to get the Z value when they give you the percentage. Even though you can cram it straightforward, 99% is 2.33 and then 95% is 1.65. Examiner is responsible for giving you the standard deviation and giving you this confidence level. The only thing that you need to do here is bring in this or that. But because, as I said, he did this last sitting, this is the reason why I'm going to show you why the 99% is this and 95% is that. So next time, if you go there and he does 88% or whatever percentage, you should be in position to do it. Okay, let me take you back to normal distribution. When we did our basic statistics, we drew histogram like this for the sake of argument. Okay, so when we do that, this is the meaning. It means there is half of the population on one side and there's half of the population on the other side, if you look at what I've done. So this can be transformed into something like this. 1 minute. Okay, so normally when we say something is normally distributed, half is here and half is there. So this is how normal distribution curve is. Okay, this is the normal distribution curve. 0.5 and 0.5. Okay, 0.5 and 0.5. Right. Now, if this is the case, this is where your mean is. This is where the mean is. So if I tell you, you are 99% confidence level. If you are 99% confident level, then there is a doubt of 1%. If there's a doubt of 1%, 1% is 0.01. The whole of this side going is 0.5. So this bit is your tail. This is the end. So this is 0.01. So between your mean and where you doubt is 0.5 minus 0.01, which is 0.49. Okay? If you have got your note in front of you, if you have got your lecture note in front of you, go to, I think, page, is it 11 or 12, just after the formula sheet, just after the formula page, you will see normal distribution table. You will see standard normal distribution table. If you have got it there, please go there. I just want to show you how they got it in case he expects you to calculate it. So if you go to your normal distribution table, you will see 0.0, 0.1, 0.2, and then you see 0.00, 0.01, 0.02 onwards. And you see figures in here like that. Okay? Now, those figures in the middle here, go there and go and look for a figure which is very close to 0.49. You will see the 0.49 somewhere here. I think it's 0.4901. And when you get a 0.4901, you are going to mark it to the end, to this line. And then you mark it up like that, to that line. You will see 2.3 here, and you see 0.03 here. When you bring the 0.03 and the 2.3, we are adding them. That is what will give you the 2.33. That is what will give you the 2.33. So if you are expected to know either 99 or 95, if they give it to you, just as long as you remember this, you multiply by the standard deviation, then you go. Okay, brilliant. So as you got a 0. No, it should be 2.3 and then 0.03. It's not 2.03 and 0.03. It's 2.3 and then 0.03. So that when you bring the 2, it's going to give you the 2.33. Same way, if it is 95% confidence level, brilliant. If it is 95% confidence level, it means you doubt 5%. If you doubt 5%, it's 0.05. So when you come to the tail here, this is where you get in 0.05. So this will give you 0.45. So go to that place again in between. If you see 0.45 here, drag it down there, you come and meet the 1.6. Drag it up there, you meet 0.05. When you bring the two together, you get 1.65. So this is how they got it. This is how they got it. And the moment you'll be able to do that, what do I tell students? Value at risk is for you, because what you need to know and the value at risk is higher than this level. So when they test it, the only problem is you being able to get the tail value. So pick this formula. You take the standard deviation, you multiply by the tail value dependent on what percentage was given to you. If it is 90%, you doubt 10%. In that case, you will say this place is supposed to give you 0.4 because this is going to be 0.1. You come in here, you come and read 0.4, you match down there, you match up there, you add those two figures. I think it's 1.2 something. I can't really get it straightforward. And then you multiply by the standard deviation. Let's go to the note quickly. We pick this question to illustrate. Yes, 1.29, brilliant. So Andrews PLC estimates the expected MPV of a project to be 100 million with a standard deviation of 9.7 million. Establish the value at risk using both a 95% and also 99% confidence level. So when you see confidence level, to be honest with you, it is a straightforward thing. Don't bother yourself with this formula. This formula is what I've simplified for you. So when they ask you to calculate the value at risk, it's the standard deviation multiplied by the tail value, which depends on the confidence level. So what are we going to do with this question? I will straightforward say, if I am doing 99% confidence level, my value at risk will be, what is the standard deviation? Standard deviation is given as 9.7. So 9.7 multiplied by what is the tail value of 99 is 2.33. When you multiply 9.7 times 2.33 is simply 20, or let's say 23, approximate. So if it's 23, it means out of the MPV given, the MPV given is my expectation of 100. Out of that 100, okay, I am doubting the value of the 100, which is at risk that I wouldn't get, is that 23. Therefore, what will be the value I will get? This is the value at risk. So the expected value will be 100 minus 23, which is equal to 77. Therefore, your conclusion is, because it's 99% confidence level, there is 1% chance that the MPV will move to 77. That's it. Easy. So when they tell you to do value at risk, please, the only thing that he shocked last sitting was he did 95 and 90. And now we know how to calculate the Z value. The standard deviation is supposed to be given to you. So if I have to do 95% confidence level, my value at risk should be the 9.7 multiplied by 1.65. So 9.7 times 1.65, and that is 16. So the value should be the 100 minus the 16. 100 minus 16 is what is given 84. It means there is a 5% chance that the MPV will move toward 84. That's it. That's all about the value for money. That table, the normal distribution table that you picked, if you go down there, they will tell you the reason why the normal distribution is there. They will tell you it's meant for the Blasco's option pricing model. Okay, so that is the case. They will tell you it's meant for the Blasco's option pricing model. It's not meant for this because you are expected to know 99 is 2.33, 95 is 1.65. But in case, because of what they did last setting, in case he tells you to do that, I think you should be able to calculate the Z value. So this is basically the value at risk. So now let's go to chapter number 4, which is going to deal with the cost of capital, Okay, what can I say? Cost of capital is going to cover chapter 4, chapter 5, and then chapter 6. Okay, up to chapter 7. Make sure that you are with me in those areas because it is, whether you like it or not, let me put it that way, whether you like it or not, you apply cost of capital in there. Either he's expecting you to calculate your own discount factor for the investment appraisals, or you need it for the mergers and acquisitions. So it is really important. It can come by itself, or it can actually be attached to other questions. What is cost of capital? Companies raise money from so many sources, broadly debt and equity. Those giving the monies, obviously, they're not going to give the money to the company for free. They will demand a return. And once they are demanding a return, the company is supposed to pay that return. So that company will see it as cost. So basically, cost of capital is the cost the company has to incur in raising money to finance its activities. Now be with me. Okay, now be with me. What I am going to say as element of the cost of capital, you have to make sure you are with me, because when you miss this element, cost of capital, the whole concept, you wouldn't understand. Okay. What are the elements of cost of capital? In other words, what determines a cost of capital? If I am doing this project, what will determine my cost of capital for this project? Okay. For those who have collected a loan before, when you go to the bank manager for a loan, the bank manager is going to tell you that my typical APR is, let's say, 5%. However, it depends on status. What is it telling you indirectly? He's telling you that when you go to him for a loan, he is typically going to charge you interest of 5%. But if your status is of the fact that you are highly risky, he has to demand a return to compensate for the risk. And as we normally say, the higher the risk, the higher should be the return. So cost of capital is made up of the risk-free rate, a return they will demand if there is no risk attached to that particular activity. However, if that activity has got a business risk and it has got a financial risk, the person giving you the money will charge you extra return to compensate for that business risk and that financial risk. And any return to compensate for risk is what is called risk premium. So cost of capital will reflect your level of risk, which we are doing it from the point of view of a company. And as such, the company, what is your business risk? What is your financial risk? The moment a company's financial risk is changing, the moment their business risk is changing, their cost of capital will change to reflect the new level of business and financial risk. So as we're going to be seeing in the near future, everything that we're going to be talking about in cost of capital, we're going to be mentioning business risk, financial risk, because they are the key issues in determining the cost of capital appropriate for a particular project. Therefore, the elements are the risk-free rate plus a return to compensate for both business and then financial risk. How do we calculate cost of capital? Let me explain something in here. At P4 level, if I have to calculate cost of capital, or if they tell me to calculate WACC, there are so many different scenarios the examiner can create in order to ask me to calculate WACC. So I'm going to take them one. When I finish, then I will summarize all of them and give you the indication as to when, if they ask me to calculate WACC, what type of WACC is he looking for? Because there are so many different types of WACC they might ask you to calculate. Which one of them is the one prevailing in the exam room? So let's go to the primary school straightforward. What I'm going to do is basically the F9 staff. Okay. In order to calculate my cost of capital, we say we are raising money from equity, we are raising money from debt. Equity holders would demand a return. The return they would demand, we see it as cost of equity. Return that debt holders would demand, we see it as cost of debt. When I get cost of equity, I get cost of debt, and I weight them together, I get my WACC, which is my overall cost of capital. How do we calculate cost of equity? How do we calculate cost of equity? There are three main ways of calculating cost of equity. The first one is what is called the dividend valuation model. The second one is what is called the CAPM, capital asset pricing model. The third one is the Modigliani and Miller. And the fourth one is the Modigliani and Miller and CAPM combined. Okay, we're going to see all of them. So far as your P4 is concerned, dividend valuation is more or less out of the equation. But what I will say is you still have to refresh your mind, because if you should test and bring dividend valuation and you are not able to do it, that will be a disaster. It's still in the syllabus. Okay, we all know these formulas before. So according to the dividend valuation model, the market value of the share should be given as the present value of the future cash flows. And once we are dealing with the present value, either the cash flow is going to be constant or the cash flow is going to be what? Growing. We've got a perpetuity. A constant perpetuity, we have that dividend divided by cost of equity. If it is with growth, you remember we said D01 plus G divided by the cost of equity minus G. So now giving me the market price, giving me the dividend, can I get cost of equity? It's an issue of change of subject. So I'll say my cost of equity should be the dividend divided by the market price. And then here the cost of equity should be D0, 1 plus the growth rate divided by P0 plus G, all multiplied by 100%. Cost of capital is formula business. It's formula business. So you need to lead yourself. Which of the formulas do I need at what point? So let's start. If I have to calculate the cost of equity and dividend is constant, this is the formula that we said. Why are we saying XDAV? Why are we saying SDAV? Because the formula said the P0 is the present value of the future dividend. Your future dividend has got nothing to do with your current dividend. Okay, therefore, that market price, which is the present value of the future dividend, should exclude the current dividend. That is why we say the P0 should always be X, excluding the current dividend. So let's take this next. The next here is that what is the cost of equity if the dividend is growing? Point of attention, D0, 1 plus G. There's nothing in here. Once there's nothing raised power here, it means it's raised the power 1. And it's telling you next year's dividend. So that formula can also be quoted as that, where the D1 is the dividend to be paid next year. So if I go to the room and the examiner says next year's dividend is 20p and dividend is growing by 5%, he had already grown it to give me the 20p. So when they say next year, you put it in there, you don't grow it again. So watch out. So let's take this example. A company is expected to pay a constant dividend of 40 pence per share. The current XDAV market price is £3 per share. What is the cost of equity? This is very easy. So my cost of equity being constant, dividend 40p. So I bring the 40p, market price is 3. This is it. If it's growing by 10%, my 40p will grow by 1.1 divided by the market price XDAV of 3 plus what? 1. And that gives you the 24.7%. So this should be basic. What is cum-div and ex-div share prices? That is what I said. Cum-div means the market price includes the current dividend. Ex-div means the market price excludes the current dividend. So based on the dividend valuation, if it is the present value of the future, then the P0 should exclude the current dividend. So giving you the cum dividend and giving you the dividend, and you want the X dividend for the cost of equity calculation, then you would have to convert from the cum to X. So this is what we are trying to establish. So your X div is the cum div share price minus the current dividend. Let me put it, this one should be the current dividend. Dividend just about to be paid, which is the current dividend in simple terms. So let's look at the example. A share is quoted cum div at 4.50. The dividend has been declared at 50p. What will be the ex-div? This should be the straightforward. Okay, this should be straightforward. 450 minus 0.5, which is 4. Estimating the growth rate. Okay, obviously, it's not every time the examiner will give you the growth rate. So you might be called upon to estimate the growth rate. How will you estimate that growth rate? To estimate the growth rate, we can use the average approach, or somebody will say the historic pattern. Okay, when will I use the historic pattern, or when will I use the average approach? You use the average approach when past dividend information is given. So when past dividend information is given, I can use the average approach to calculate it. And what is the formula? Is D0, which is the current dividend, divided by dividend paid n years ago, all raised to the power 1 divided by n. N is the number of years of growth. And of course, 1 is 1. Okay, so let's take this example. A company currently pays a dividend of 32p. 5 years ago, the dividend was 20p. Estimate the growth rate. This is simple. I will say my dividend now is 32, 20p, paid how many years ago? 5 years ago. So it's 1 divided by 5. And then you solve it, that should give you approximately 10%. These are primary school stuff. That's why I'm moving on. Some of the chapters, chapter number 2 and chapter number 3, you saw what was there. That's why we still a bit delayed here, but we balance it because these ones are relatively easier. Okay. So next example, the dividend of Porto PLC over the last 5 years are given below. Year 1 up to year 5. Porto PLC current ex-dividend market price is £4 and it has in issue 1 million ordinary shares. Calculate the company's cost of equity. When you have to calculate cost of equity using dividend valuation, the simple common sense here that you need to apply is because there are two formulas. Which formula? Dividend, are you constant, or dividend, are you growing? I always encourage students to be interacting with the question. So if I have to use dividend valuation, question is your dividend constant, is your dividend growing because of the differences in the formula. If you misjudge, obviously you've got it wrong. Here, straightforward, dividend is growing. Past information is given. I should be able to calculate the growth rate. And it's telling me my current dividend is 280. My dividend paid some time back is 180. I need 1 divided by n. What is n? N is the number of years of growth. How many years is dividend grown? Dividend, even though they've given us 5 years, dividend hasn't grown by 5 years. Dividend has grown by 4 years because it's grown from year 1 to year 2 to year 3 to year 4 to year 5. It's grown 4 years. So you're going to say raise the power 1 divided by 4 minus 1 and you get about this 12%. Remember, when I say 5 years ago, n is 5. But when I give you 5 years like this, n is 4. It's just like if you were born 2001, 2005, how old will you be? I'll be 4 years old. When I'm standing in 2005, I will say I was born 4 years ago. You can't say you were born 5 years ago. If you were born 5 years ago, why are you not 5, but you are 4? Remember, when you are counting, this is your starting point. That's your base. Okay, so watch out. When they say 5 years ago, if you look here, because they said 5 years ago, we put 5 there. But when they gave us 1 to 5, we use 4. Watch out. Okay, and then you put it in the formula that you need the last dividend, which is 0. This. Watch out, it should have been 12% here. It should have been 12%. So it should be 0.28 times 1.12 divided by 4 plus 0.12. 1 minute. 0.28 times 1.12 divided by 4 plus 0.12. That should have been 19.84%. Okay, watch the percentage. Brilliant. Okay, this is a calculator thing. If you pick your scientific calculator, I'm not sure of the scientific calculator that you are using, but some will say, some they do X like this, and they do like that. Some they do X, they do box on there. Okay, some they just do, is it X raised the power Y or Y raised the power X? Okay, I'm not sure of the scientific calculator that you are using. That is why I encourage every student that you need to get your scientific calculator now. The one you take to the exam, you have to bring out now so that you will be able to use it and get how to manipulate it, because every calculator and the way it functions. If I pick mine, I will say 280 divided by 180 equals, then I'll press mine is X, and then there's a box there like that. So I will press that one, and a bracket is open. I will do 1 divided by 4. I close the bracket, press the equal sign, minus 1. And that is what is giving 11.7%. Okay, so it depends on the scientific calculator that you are actually using. Right. We can also use the Gordon's growth model to calculate the growth rate, which is giving us G is equals to RB. Gordon is telling you that R is the accounting rate of return, or simply the return on investment, and B is the proportion of the profit retained. B is the proportion of the profit retained. Point of attention, you don't need these growth formulas, either Gordon's growth model formula or the average formula, only when you are doing dividend valuation. You need these formulas everywhere you are supposed to use or calculate growth rate. If I had given you, if we're doing free cash flow, remember, when we're doing free cash flow, we will say, oh, free cash flow is going to infinity. It might be constant, it might be growing, blah, 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 blah. Examiner reserved the right not to give you the growth rate. So if I have told you that, oh, the free cash flow in the past are these. Okay, the free cash flow in the past are these. What would you do? It means the free cash flow was growing. You use the same formula, you come and get the growth rate of the 12%. And that is what you are going to use to project the free cash flow into the future. The same way, the examiner can say RB. R is the return on investment, and B is the proportion of the profit or funds retained. So if I tell you that when I make a free cash flow, 40% is retained, that is my B. And cost of equity, or the return on equity, is 10%, that is my R. Okay, so don't limit yourself to these formulas only when you are doing dividend valuation. It could be tested when you are doing what? Free cash flows especially, or anywhere you need growth rate. When they give me past information, I can use the average. When they give me its RB, I can use it to calculate that particular growth rate. Okay, so let's take this example. Consider the following. The current cum div market price, current dividend, dividend payout ratio, average return on investment, calculate cost of equity. Okay, dividend is 40 pence, 60% is paid out as dividend. It means 40% is retained. Okay, and then the accounting rate of return is, or return on investment, is 10%. What will be your RB? Your R is 10, and then your B is 40%. Dividend growth rate is 4% straight. But they gave us the cum div market price. So given the cum div, I have to convert it from cum to X. And that is why we converted. Cum price is this, dividend is 40p, so the X price is 2.1. And because it's growing, our current dividend is 40, growing by 4%, divide by the X div, add everything by the 4%, and that will give you the cost of equity. Okay, that will give you the cost of equity. Right, so let's go to cost of preference shares, which is straightforward. Your cost of the preference shares should be given as the D divided by the P0 multiplied by 100%. Forget about an N. I don't even remember the last time a question in P4 will ask you to calculate the cost of preference shares, to be honest. Okay, they normally want the capping and the midline and Modigliani issues anyway. But as I said, it's still in your syllabus, so we quickly have to go through, refresh your mind on them, and then in case he has to use it to balance time for you, and you grab that easy mark. A company has in issue 100,000 6% preference shares of £1 each with a market price of 40p. What is the cost of preference share capital? Straightforward. Remember, dividend, interest, when given as a percentage, is applied on nominal values. We don't apply interest as a percentage or dividend as a percentage on market prices. We base it on nominal value. So here they've given me market price of 40p. I can't base the 6% on that. I would have to base it on the nominal value of the share. Remember, interest, dividend, when given as a percentage, is applied on the nominal value. Okay, so 6% of £1 is giving you 6 pence divided by the market price, which is 40 pence, and that gives you 15%. That gives you the 15%. Okay, cost of irredeemable debt. The cost of irredeemable debt, just like cost of equity when the dividend is constant, just like cost of preference shares, because preference shares attract a fixed rate of dividend. Interest, irredeemable debt interest is also what? Fixed. But remember, interest is a tax allowable expense. So the cost of this debt is simply the interest multiplied by 1 minus t divided by the X interest market price. We're not going to say X Dave. We're not going to say X Dave. We're saying X interest because we pay interest on such instrument. Okay, so this one is X interest. So let's take this example. A company has in issue 5% irredeemable loan note currently quoted at 105.5 cum interest per 100 nominal. Assume a corporation tax of 30%. Calculate the cost of the debenture. Okay, your interest, dividend, when given to you as a percentage, should be based on the nominal value. So 5% should be based on the nominal value of 100. 5% of 100 will give me interest of 5. Okay, so if I've got interest of 5, the market price is quoted at cum interest. I have to knock it off. 5 off because we said X is the cum minus. Okay, so that's what we did here. Your cum price is 105.5 minus the interest should give you the X interest. You are taking the interest off to bring it to X. Then the interest is this, tax rate is 30% divided by X interest market price multiplied by 100, and that is basically 3.5%. That is basically 3.5%. Cost of redeemable debt capital. Okay, if it's a redeemable debt capital, the cost of it will be the yield to maturity. You would have to pay a return up to maturity. So they normally call it the internal rate of return or yield to maturity, or somebody will say redemption yield. One thing with multiple names is redemption yield. All of them are alternative names for internal rate of return. So if I have to calculate the cost of the debt, I ask, is it redeemable or irredeemable? If it's redeemable, I need the internal rate of return. If it's irredeemable, I need net interest divided by X interest market price multiplied by 100%. So cost of capital, because it's formula based, you still have to be leading yourself. You have to lead yourself in order to get the appropriate formula for that particular question in front of you. If it is cost of equity and I see I have to use dividend valuation, are you constant or are you growing? That is the argument, because each level has got its own word, formula. If it's growing, am I giving growth rate? If growth rate is not given to me, it doesn't mean the question is wrong. I asked the question, do you want me to calculate it? If you want me to calculate it, then you either have to give me past dividend information. Have you given me past dividend information? Question says yes. I pick it, I calculate it. Question says no. Okay, if you haven't given me past information, I can't use the average. Then is it possible for me to use the Gordon's growth model? Have you given me return on investment? Have you given me the proportion of the profit retained? Question says yes. I pick it. I carry on. Question says no. Okay, question, you haven't given me RB. You haven't given me past information. You haven't given me the percentage of growth. Therefore, your dividend is constant. Then I pick the constant formula and I carry on. This is how you would have to interact. You ask the questions. The question will be feeding you back. Okay? The question will be feeding you back. And then you answer it. This is my approach. Okay? If you don't interact with the questions through your principles, you'll be doing your own thing. You'll be doing your own thing. Meanwhile, the question is hiding certain things in there. Most people will say, oh, it wasn't growing. Meanwhile, it was growing. Or it wasn't growing, then they say it's growing because they haven't led themselves. Okay, so let's take this example. A 5% loan note is currently quoted at 95.84 x interest. It is redeemable at the end of 3 years at 100. Taking corporation tax at 50% and ignoring the timing lag for tax savings, calculate cost of debt. Because this is actually redeemable, I would have to calculate internal rate of return. To calculate internal rate of return, I need 2 MPVs with my own 2 rates. So first, I would have to generate the cash flows. Cash flows, I need to buy the investment now. When I should buy this debt, I have to pay the X interest. So year 0, this is basically the market price. Market price, I pick this. Then year 1 up till year, how many years? 3 years. I would have to get interest. I would have to receive interest. Don't forget about tax. Interest is 5%. Remember, interest is a percentage based on nominal value. 5% of 100 will give me 5. But because tax is 50%, what will I do? I need to knock off the 50% off. So I get net. So year 1, I will get 2.5. Year 2, I will get 2.5. Year 3, that is the year of redemption. In the year of redemption, I will get the 2.5 interest, and at the end of the period, I will redeem and get my 100. So I will get 102.5. Somebody can also decide to use the annuity approach. And then you have to choose your own 2 rate. What did the notes do here? The notes did a magic because it's implying that we all know how to calculate the internal rate of return. We all know internal rate of return is the rate that should make the MPV cost 0. So when you make these cash flows, you would have to choose your own 2 rate to get 2 MPVs. If you are lucky enough, you pick the first rate and straightforward, your MPV is equals to 0, then obviously you are a magician, and as such, that is the internal rate of return. Because the internal rate of return is the rate that should make the MPV cost 0. So if I assume 4% and the MPV is 0, then straightforward, that is the cost of debt I'm looking for. That's it. They try to do something here for you, that if somebody had assumed 3%, the MPV would have been that. If somebody has assumed 5%, MPV would have been that. And you remember this formula. We put it in the internal rate of return. The lower rate plus the MPV of the lower rate divided by MPV of the lower rate minus will bring you to the plus. Multiply by the higher rate minus the lower rate. We all know that, which is close to 4.02. So when you pick the first rate and it gives you a percentage or MPV which is very close to 0, that is what you are looking for. Okay, what is the cost of a convertible debt? The cost of a convertible debt is straightforward, the internal rate of return. The cost of a convertible debt is straightforward, the internal rate of return. Okay, simple. Because all convertible debt are redeemable. Technically, what is a convertible debt? A convertible debt is a debt that has got the right to be converted into shares, ordinary shares specifically. So what is going to happen is that when you are having the shares on the when you are having that convertible debt on the maturity date, either you are going to convert it into shares or you are going to get your money, which is cash. So whatever the case is, come the end of the period, the debt will not be there. It will be redeemed. It is redeemed either by paying cash or redeemed either by paying shares. When we redeem using shares, we don't call it redemption. We call it conversion. It means you have converted it. But when we redeem it using shares, that is where we say it is what? Redemption. So the biggest question here is, if I have to calculate the internal rate of return, when I get to the last year, I will need either conversion value or redemption value. That is the only difference between the cost of a convertible debt and the cost of redeemable debt. Redeemable debt, you haven't got any option. You simply have to redeem it. That's why we bring redemption value straight. But when it is convertible debt, because the person has got these two options, either conversion or redeeming, you would have to test, is redemption or conversion likely? Common sense here is that the investor is rational, and as such, the investor will be prepared to take the option that will give him the highest value. So if my conversion value is more than redemption value, then I will calculate it upon conversion. If my redemption value is more, then I will calculate it upon redemption. Simple. That's why your note is telling you, check the redemption value and conversion value and base it on the one that is giving you the highest value. Let's take this example to illustrate. Some 8% convertible debentures have a current market value of 106%. The debenture will be converted into equity shares in 3 years' time at the rate of 40 shares per 100 of debentures. The market price is expected to be 3.5 on the date of conversion. What is the cost of capital to the company for the convertible debentures? Okay. Assume a corporation tax of 33%. It's an internal rate of return. First, generate your cash flows. How many years is this debt supposed to go? 3 years. So that is what we've done here. So I'll say year 0. First, bring the market value. The market value of the debt, is it 106? So I'll put the 106 there. Then year 1 up to year 3, I would have to receive net interest. Okay, what is the interest rate? It's 8%. 8% based on not market price but nominal value. 8% of 100 will give you 8. There is tax of 33%. Therefore, you will get net of 67%. That's what we did here for you. And that's why you are getting interest of 5.36. So that is my interest, year 1 to year 3. This time we are using annuity. Okay, if you go to the room and there's a question like this, I would prefer you to use annuity to save time. Okay, next, at the end of the period, which is year 3, because this is a convertible debt, we would have to test and check whether conversion is likely or redemption is likely. Which one is likely? I need to get a redemption value. We will redeem it at par. Okay, we will redeem it at par, even if it is not said specifically how much it will redeem at. You assume that it will redeem at par. So par value of the debt is 100. So my redemption value is 100. Then I will need conversion value. Conversion value is the value of the shares you will get if you decide to convert the debt into shares. If you come here, it's telling you that you can convert 40. Okay, every debt you have can be converted into 40 shares. So every 100, I will convert it into 40 shares. So what is the market value of the 40 shares? As at the date I am converting it. Question told me date of conversion, the market price of the share is 3.5. So if on the day I am converting, each share is at the price of 3.5 and I'm going to get 40 shares, what will be the value of the 40 shares? That's why they did the 40 multiplied by the 3.5 to give you the 140. And the 140 is higher than 100. So rational investor will decide to convert. So you have to bring the conversion value. You would have to bring the conversion value. You have to choose your own 2 red as long as you've got these cash flows. You would have to choose the 2 red. So the note shows 12%. You go to the table, year 0 is 1. Then because it's annuity, go to the annuity table. 12%, 3 years. This is specific year. So go to the present value table. This should be a primary school thing by now. And this gave us MPV of that. Because this is positive MPV, we all said when we're doing the internal rate of return that there is an inverse relationship between cost of capital and MPV. So if I've used 12% and it's giving me a positive, which is profit, If I want a loss, what should I do? I have to increase my cost. That's why they increased it from 12% to 15%. It's your choice anyway. I told you can even get to positive NPVs. You put them in the formula. That is okay. And then they brought the discount factors from the annuity table and the discount factor table. They also gave you the NPV. And then we put it in the formula. Everybody should be okay with this at this time because we've done internal rate of return. And this is how we calculate the cost of a redeemable, a convertible debt. In this case, a convertible debt. Okay. How do we calculate the cost of a short-term debt like bank loans and bank overdraft? If the bank overdraft is substantial, to be honest, I haven't seen this long time ago. Okay. If you go to the bank manager for a loan, what will be your cost? Your cost is simply interest. But don't forget, we are doing it for a company, and when a company pays the interest, they would have to come and put it in the income statement. Interest is a tax allowable expense. So my cost is not what I pay to the bank manager, because what I paid to the bank manager saved me interest. So my overall cost will be what I paid minus the tax I saved on that interest. And as such, it is the interest rate. It's not interest. It should be the interest rate 1 minus T. Because you are expressing as a percentage. So when they tell you to calculate the cost of a bank loan, it's not part of it. A company has 8% bank loan with a book value of 3 million. What will be the cost of the bank loan if there is 30%? There's 30% tax. The formula: your interest rate is 8%, tax is 30%, so the cost of the bank loan is 5.6. Now that we know how to calculate the cost of every source of finance, we bring all of them together, and when we bring all of them together, we call it the weighted average cost of capital. Okay, WACC. This is what basically we did in F9. Okay, this is basically what we did in F9. So weighted average cost of capital will be the weighted average of the cost of equity and the cost of all the various debt. And when you are weighting, remember, we would have to weight it on the basis of market values. We would have to weight it on the basis of market value of equity and market value of debt. So I tell students, if you tell me to calculate normal WACC like this, as at this point, my answer will be WACC should be the weighted average of all the sources of finance the company has raised money from, their costs and their market values. So for each of the sources of finance the company has raised money, I will calculate their costs and I'll calculate their market values. When I finish, I weight them together. This is the WACC. So this is the principle. You go there. For basic WACC, all what I need is company, where have you raised money? Wherever they've raised money, I will calculate the cost of that source of finance and I will calculate the market value of that source of finance. When I finish, I weight all of them together and the WACC is got. So this is the formula for calculating WACC. This is the formula for calculating WACC. So cost of equity, market value of equity, this is the proportion of equity in the total capital. And the total capital is made up of equity and debt. Cost of debt, 1 minus T, value of debt, and the total. What is the proportion of debt in the total capital? So this is basically how we will have to calculate cost of equity. Let's take this example to summarize whatever we've done. Okay. The management of Han PLC is trying to decide upon a cost of capital discount rate to apply to the evaluation of investment project. The company has an issue share capital of 500,000 ordinary £1 shares with a current market value, cum Dave, of £1.17 per share. It has also issued 200,000 of 10% debentures, which are redeemable at par in 2 years and have a current market value of 105.3% and 100,000 of 6% preference shares, currently priced at 40p per share. The preference dividend has just been paid, and the ordinary dividend and debenture interest are due to be paid in the near future. The preference dividend is shown net. The ordinary share dividend will be 60,000 this year, and the directors have publicized their view that earnings and dividend will increase by 5% per annum into the indefinite future. The fixed asset and working capital of the company are financed by ordinary shares of £1, 6% £1 preference shares, debentures, reserves, Calculate the WACC, assume corporation tax of 50% per annum, payable 1 year in arrears. Okay, so if I have to calculate the basic WACC like this, as I said, I ask the question, where have you raised money? Equity is ordinary share capital plus reserve. Don't forget. So they've raised money from equity, they've raised money from preference shares, they've raised money from debentures. So what will be the WACC of this company? For each of these sources of finance, I have to calculate its cost. I have to calculate its market value. When I finish, I weigh them together. That is all about WACC. So I need to calculate the cost of equity. If I have to calculate cost of equity, I see here I have to use dividend valuation. If I have to use dividend valuation, I'm going to ask this question. Do I need to use constant dividend formula or do I need to use the growth? Question is telling me dividend, they said, is expected to grow by 5% per annum. Therefore, I need the dividend growth formula. So I am going to say my cost of equity should be the D0, 1 plus the growth rate divided by the P0 plus G multiplied by 100. I put it there. I go to the question, can you give me this information? Anything in the formula which is not given to me directly, it means the examiner is hiding it. I pause, I go and do the workings on it, I come and put them in. If it is given to me, I fill it, I pick my calculator, I calculate, I move on. That is the strategy. You know what you're supposed to do. The moment you read the question, what are you supposed to do? I'm supposed to calculate WACC. I need cost of equity. How will I calculate the cost of equity? Okay, I have to use dividend valuation. Okay, are you growing or are you constant? We've seen it's growing. I put the formula down. Now let's go to the question. What is the dividend? The dividend they paid is 60,000. So I'm going to put total 60,000. Dividend is growing by 5%. Divided by plus 0.05 or multiplied by 100%. Now, what is the P0? Point of attention. Because I have put total dividend here, I can't put market price down here. I need to put the total market value as well. What do I need? The P0, we said it should be X. I asked the question, where is your X market price? If the question hasn't given me the X, I know what to do. So you go to the question with what you need because of your principle. You don't go to the question and ask the question, what am I supposed to do? No. You go to the question demanding what you need to fit into the principle. The question will be giving you the answers. Okay, so if I come here, the question is telling me the cum Dave market price is 1.17. Okay, market value should be number of shares multiplied by the market price. So when I multiply the 1.17 by the 500,000, because the 1.17 is cum, I get the cum market value. If I've got the cum market value and I want the X, I need to knock off the dividend. I've got it. I go and put it there. This is your flow. This is your flow. And it will be very, very easy. But if you don't lead yourself and you just look at the question, you wouldn't know what you have to be doing. Okay, because it's the principle the examiner is going to use to form the question. So if the principle is with you and you ask the question with the principle, you see the answers coming out. Okay, so we come here. What will be the market value? What will be the market value X? X div. I'm going to say the 500,000 multiplied by 1.17 minus the 60,000 dividend. So 500 times 1.17 minus 60. And that is giving me 5,000. And what will be the price? So 60,000 times 1.05 divided by 5,000 plus 0.05. That is giving about 17%. We said for each of them, you calculate cost of capital, you calculate the market value. I have calculated the cost of equity. I have calculated the market value of equity. I move on to preference shares. I need cost of preference shares. How is it calculated? Cost of preference shares is calculated as dividend divided by the ex-div market price multiplied by 100%. I go to the question, Can you please give me the market price? Can you please give me the dividend on the preference shares? When I go to the question, they've got 6% preference shares with a nominal value of £1 here. Because we said if the dividend is a percentage, it should be based on nominal value. So if I've got a percentage of 6%, where is the nominal value? This is the nominal value. What was given here is the market price. So I'll say my D is equal to 6% of 1, which is equal to 6. Therefore, the cost of the preference share is 6 divided by, I need X-Dave market price. What will be the X-Dave market price? What will be the X-Dave market price? Now let's come here. Question said they've got 100,000 of 6% preference shares currently priced at 40p per share. Question didn't directly tell me at that point that the preference preference market price is cum or X. But the question further stated something which tells me that it says the preference share dividend has just been paid and the ordinary dividend and the debenture interest are due to be paid. If the dividend is due to be paid, it means the market price is cum. If the dividend is already paid, it's gone. Therefore, the market price is X. So if the preference dividend has just been paid, then that 40 is excluding the dividend that has already been paid. It's gone. Therefore, I can pick the 40 and I divide by 40 multiplied by 100%, and that is what is giving 15%. What then will be the X-Dave market value? I will get the 40p multiplied by, they have got 100,000 shares. So this one will give me £40,000. Okay, I am done with the preference shares. Now it's left with the debenture. Debenture, if I go to the debenture, I need its cost, I need its market value. I need its cost, I need its market value. I go to the question. I know my principle tells me if it is debenture, it could be redeemable or irredeemable. If it is redeemable, I need internal rate of return. If it is irredeemable, I need the net interest divided by X interest multiplied by the market price. So question, which debenture have you got? Question, answer me. My debenture is redeemable. So if your debenture is redeemable at par in 2 years' time, then you want me to calculate the internal rate of return. How will I calculate that internal rate of return? I need a number of years. I need relevant cash flows. I need my own discount factor. How many years? 2 years. Okay, if it is 2 years, then let's do it. I will say year. Okay, I will say year 0, 1, 2, and then 2 years. Right? Then I will say, what is the market price? What is the market price here? The debenture market price is given to us as 105.3. That market price. Unfortunately, most of the formulas are not there. You would have to memorize them, unfortunately. All the formulas which will be available to you in the examination room are those ones that we've given to you on your in the lecture note. I think page 9 or so. Check it. So any formula we are using here, which is not on that page, unfortunately, you are expected to bring it from memory. Okay, unfortunately. Right? So be with me here. The market price was 105.3. They didn't tell us that market price is X or cum interest, but they told me debenture interest is not yet paid. Debenture interest and the dividend on the ordinary shares are yet to be paid. Therefore, this market price is what? Cum. If it is cum, I have to bring it to X. Interest on the debenture, they said is 10% debenture. Interest, we said, is the interest rate multiplied by nominal value. Nominal value is given to you as 100. Therefore, I would have to calculate the interest. You see how I'm answering it? So I'll say my net interest, or let me put it this way, interest will be 10% of the nominal value of 100, which is 10. So if I want the X interest market price, they said the cum is 105.5 minus the 10, and that will give me 95.5. I come and put a 95.5 here minus. Year 1, year 2. Yes, Nominal value, the examiner, very good, very good. Nominal value, the examiner has got any right not to give it to you. Okay, look at what they did here. Okay, nominal value, the examiner has got every right not to give to you. You have to bring it. Ordinary shares and debentures, the nominal values are not standardized. The nominal values are not standardized. So every question will give it to you. That is why here they gave you the 1, and for preference shares they gave you the 1. It's not standardized. So every question will tell you what is it, either 0.25 or 50p or whatever they will use. But when you come to traded debt like debentures, loan note, they won't tell you. So it's examination. If you go there and the examiner don't say anything about the nominal value, you would have to assume it's equals to 100. But here, they told you, look here. If you come to this bit, look at what it said here. It said 105, the market value of 105.3%. Percent means 105.3 per every 100. Per every 100. So the percent there is telling you the nominal value is 100. So the price of a nominal value of 100 is equals to 105. So the price per 1, obviously, that is the case. So if it doesn't tell you, you need to bring it. Okay? So interest. Now, if interest is 10, we need to deduct tax. But look at what the question said. Tax is 50% paid 1 year in arrears. So what am I going to do? You have to be very careful here. I have to get interest in year 1, which is 10. Okay? Interest in year 2 is also 10. But the tax in year 1 will be paid in what? Year 2. So the tax will be 5 here minus. And then when the year 2, there should be what? Redemption value. And redemption value is going to be 100. And the tax on the interest on year 2 should come to year 3. Okay? So if I have to, and then that one will be minus 5. If I have to do this, I'm teaching, that's why I'm showing you all that. If I have to do this, I would have said, yeah, this is 0. Market price is 95.5 minus. Then I will say year 1, interest will be 10. Year 2, interest plus the redemption value will be 110. And then I will say minus, there's a 5, isn't it? Minus the tax, minus the 5. So that will give you, is it 105? And then year 3, I will say only the tax, which is minus 5. Okay, so that is the case because this is 10 minus 5 minus this, which is 105. So if you get the cash flows, you will pick a discount factor. And then if you go to the note, we did a magic again because we wanted to. So we used about 8%, and the 8% gave us what? MPV, which is minus 0.2. Very close to 0. So we'll say the cost of the debt is 8%. So you calculate the internal rate of return with 8%. The MPV is equals to 0, just as we know already. So I'll say my cost of the debt should be equals to 8%. I've got the cost of debt. I also have to get the market value of the debt. How do we get the market value of the debt? Point of attention, be with me. Okay? When you wanted the number of shares, what will you have done? You will pick this total nominal value of the shares and you divide by nominal value per share. So this was the 500,000 divided by £1. And that gave us 500,000 ordinary shares. Preference shares, you will pick the 100,000 preference shares divided by £1 and it will give you what? 100,000 shares. When you come to the loan note, that is where most people do get it wrong, even from F9 level. So let me clear it, okay? This, they are not going to put it here for you. because we've just said that that nominal value of £100 is standardized. They won't put there for you. So don't forget that just as you did this for the shares, here too, I will say 200,000 divided by 100, all of them in pounds. And that will give me the unit of the debentures issued. So I will get, is it 2,000? And the market price that we are going to multiply is the X interest. So I will calculate my market value as the 200,000 divided by the 100 multiplied by the 95X price. 95 point, is it 95.5 or 95.3? Let me check it again. 95.3. 95.3 because it's 105.3, and that should give you the market value 200,000 times 95.3 all divided by 100, and that is 190,600. Have you got the cost of equity, cost of debt, and their market values? As long as you've got the cost of all the sources of finance and the values for all the sources of finance, well, your work is ready. So my work will be, my cost of equity was 17%, my market value of equity was 525,000, plus the cost of the preference shares was 15%, market value of the preference shares we said is 40,000, plus the cost of the debt we said is 8%. Remember, if you look at the work formula, the cost of the debt, there is 1 minus T. If you look at the work formula, the cost of the debt, there is 1 minus T. Watch out. When we were calculating the cost of the debt, we had already taken out tax. These were the tax figures. If you remember, we've already taken tax. So the answer we've got as the 8% is already after tax. Once it's after tax, you don't come and deduct 1 minus T here again. Otherwise, you know that you've duplicated it. And the value of the debt is 190,600. This plus that plus that. Okay, 190,600 plus 40,000 plus 525,000, and that is 755,600, 755,600, 755,600, and that will give you work of about 14%. Okay, so that is the way you calculate the basic tax. Basic work. Okay, so our time is up. Okay, our time is up. The only thing that is left we haven't just done, as you see, we are bringing ourselves to that level, is the theories of what? Gearing. So I will pick it up next week as well, and then we will get to the capping. Okay, it's not as detailed as the first two topics that we were doing or chapters that we were doing. There were so many things. So hopefully by next 2 weeks, we should be able to bring ourselves to that level. So my advice is you now look at how to calculate what? The work, how to calculate basic work. All those formulas. When should I use A? When should I use this formula? When should I use this formula? All of them will come up if you are able to lead yourself. So you know those formulas. Oh, if it is redeemable, I would have to calculate internal rate of return. If it is irredeemable, I would have to use the net interest divided by market price. If it is convertible, it is redeemable. So that is how you would have to be learning them. Okay, so as you learn, oh, it's dividend, it's growing, I need a growth formula. How will I calculate the growth rate? Because everything in here, there is 1 or 2 or 3 or 4 formulas for doing them. Most cases, 2 formulas for doing the same thing. Which one you will use in the exam room, I can't stand here and say it. It depends on the question in front of you. That's why I encourage you, talk to the question. I know I can do this. I can do it this way. I can do it that way. Which one do you expect me to be using? The question has to give you the answer by providing the necessary information for you to be able to know which of them. So now go through the cost of capital. Any question that you might have, you can send them through email so that I'll be able to address them for you. So when I see you next week, we will pick it from the Miller and Modigliani. We look at capping and then the APV. So in the meantime, thank you very much for your time, and I'll see you next week.